Good afternoon and welcome to Biztech's Asian Midday Market Watch, powered by our Rajhi Bank, Malaysia. Today we have a new guest on the show. She's Charu Chanana. She's the market strategist from Saxo Markets Singapore. Charu, good afternoon and welcome to your first show.
Good afternoon, Brian. Thank you for having me.
Now, Charu, before we get your insights, we're going to take a quick look at crypto markets as well as regional stock markets. We start with crypto markets, and Bitcoin is at 22,032. It's up 7.94%. Ethereum is at 1,255.25. It's up 7.09%. Now, looking across the regional stock markets, we've got the SGX Straits Times Index, which is up 0.15%. Across the region, we've got the KLCI, which is up 0.42%. Shanghai is up 0.19%. The ASX All Ordinaries is up 0.75%. The Nikkei is up 0.68%. The Hang Seng is up 0.21%. And rounding up the numbers, we've got the Kospi, which is up 1.09%. Now, Charu, could I get your insights into what your view is on market performance in the first half of the day?
Sure. So, last few weeks, we've been seeing that the markets have been battling this inflation versus recession rhetoric. But this week particularly, we've seen the recession rhetoric pick up considerably. But now, over the last few days, we've had some Fed speakers who've come on the wires and kind of said that, they are going to continue with aggressive tightening because inflation still remains the focus. And that is the Saxo view as well. I mean, we do think that inflation is going to be higher for longer and the Fed will have to continue to be aggressive to catch the inflation train. So now today, we are seeing a little bit of a revival in risk sentiment, but that has particularly come from China announcing some stimulus measures yesterday. I think that's the only hope really for the global markets right now, whereas in the other markets, we are seeing, a little bit of risk rallies, but we think these are short-term uptrends in an overall bear market trends, where I think, a lot of traders and investors are trying to cover their short positions, or as well as some dip buyers. But we do see a lot of challenges going into the third quarter as we start to see second quarter earnings hit in from next week. We do think that the market is poised for more downside.
Now, Charu, I want to ask you a little bit about the stimulus packages announced yesterday in China. Could you share some insights into some of the details and how it potentially could impact the rest of the world?
Absolutely. So, for China, the tricky situation obviously has been the zero COVID policy that they are still sticking with. And because of that, I mean, we've seen citywide lockdowns in Beijing and in Shanghai in the second quarter. And what that means is that GDP data for China is due next week, and we will potentially see downsides there. Now for 2022, their overall growth target is at 5.5%, which does look like it will be difficult to reach there, with all the zero COVID policies that they've had. Then the property sector has also seen restrictions, which is about 20% of China's GDP. And thirdly, of course, a lot of this regulation over technology sector and some of the other sectors as well. So these three factors have contributed to, headwinds to China's growth story. But now, of course, it is politically a very important year for China. They have the 20th Party Congress later on in the year, and they want to get as close as possible to their 5.5% growth target. So we are going to see some of these stimulus measures pick up further traction in the second half of the year. The measures that were announced yesterday were quite focused on the infrastructure side, and we do think that China is going to continue to prop up infrastructure to bring up its growth levels. However, I think one thing to note here is that infrastructure investments will have some amount of lag in terms of translating into real economic growth. So again, having said that, I think that is not really enough to get China's growth rates higher in the second half of the year. The other thing that would potentially help them is that even though they continue to stick with their zero COVID policy right now, there are some subtle signs that we will likely not see citywide lockdowns again, as we've seen in the second quarter. Lockdowns will likely remain more targeted. So that should help consumer sentiment to improve and consumer demand to pick up, and that will also provide some impetus to growth levels in the second half of the year. But in terms of the global economy, of course, we are looking at slowdown from here, more so in the Eurozone than the US. But of course, still we are looking at a global slowdown from here, and that would be a drag on China's export demand. So given all of that, looking into these factors, it does look likely that China will have to continue to announce these support measures to kind of support their growth story.
Now, all eyes for investors right now are on the non-farm payroll numbers, which are out later today. Charu, what are your thoughts on this, and how do you see this then also in the context of US equity markets?
Okay, so in terms of the US non-farm payrolls, of course, it's one of the very important metrics from the US economy, especially at this time when we are seeing slowdowns in parts of the economy. So consumer demand is slipping a little bit. Consumer confidence is down. Home sales is running lower as well. And the Fed still needs to focus a lot more on inflation right now. They've been late to understand that inflation is not transitory. So they have to kind of respond in an aggressive way to get it back lower. I personally don't think that inflation can get back to the 2% levels that the US economy has been used to. They will at some point have to understand that they need to bring up their inflation targets. Otherwise, they run a risk of a very deep recession in the US. So the job market is particularly giving them some level of comfort for now to address the inflation concerns. The Fed has a dual mandate, inflation and the labor market. So when both of these conditions allow them to tighten policy, they're going to press ahead with it. But only if we do see signs of softening in the US labor market. Now that will become the real tricky situation for the Fed. Because like I said earlier, our view is that inflation is going to stay higher for longer. But if the job market starts to suffer, they will have less and less room to respond to those inflationary pressures. But for now, today, what we are expecting for the June numbers, I mean, I've seen consensus is around 270K, which is, of course, a slowdown from the kind of levels that we've seen earlier in the year. But it's a moderation rather than a slowdown, I would call it. So there are signs that the US labor market is still quite hot. It is still quite tight. We will have to continue to watch that. We have to continue to watch the wage pressures as well, because although the Fed does want to bring down the wage pressures, and because that helps to cool down inflation as well, if it goes down a lot, again, that kind of hinders the extent of tightening that Fed can press ahead with.
Now, Charu, final question. Commodity prices have been heading south for the last couple of weeks. Given the global slowdown that we are anticipating, what is your view on commodity prices overall?
So, at Saxo, we've been looking at gains in commodity prices since November of last year, and that has played out really well. But now is a time, I think, we need to break down the commodity basket and look at the individual sectors. I think for the energy side, we still do see potential upside in the second half of the year. And that's because we do not anticipate a level of demand destruction which could bring the market back in balance. So the supply is really short. OPEC producers are not able to, get to their production targets. Given the supply, the oil companies have not been investing in infrastructure because of all the shift that we saw towards ESG over the last few years. So now we are in this really tight supply situation. And we do not expect any amount of demand destruction to bring the market in balance. So that goes to say that there is potential room for upside for the oil prices. What we're seeing right now is a lot of speculative and technical traders kind of having an upper hand because of these fears of recession building in. But our sense is that once the market gets back to focusing on fundamentals, we will see the uptrend there. In terms of the metals space, however, I think the bigger focus is, of course, on how China comes out of its lockdowns. And China is the key consumer of commodities and metals particularly. And with them also bringing this focus back on infrastructure development, I do see potential for some pickup in the metal space, although I don't think the gains will be as rapid as what we've seen earlier this year as well. But on the grains side, I potentially think that the weather conditions obviously play a big catalyst, and we will need to kind of watch how that develops. Of late, we've seen some better reports from the US planting season. So that kind of helps. But again, the other key catalyst for the grains is the Ukraine situation, because Ukraine is a key grain supplier as well, and how that resolves, and if we are able to see some of the grains come out from Ukraine's silos so that it is ready for its next crop storage. So yeah, a lot of catalysts, a potentially slower pace of growth, but given this physical lack of supply, we still do think that there are gains to come in the commodities market.
Now, Charu, thank you very much for coming on the show, and thanks for your insights.
It was great. Thank you. Have a good weekend.
Yeah, you too. Now, we've been speaking to Charu Chanana, the market strategist from Saxo Markets Singapore, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.